In less than 48 hours, silver went from looking untouchable to looking untradeable. On Wednesday, January 28th, 2026, the market printed prices near $118 per ounce. 2 sessions later, traders were staring at prints in the mid-70s. 44. That is not a normal pullback. That is a forced reset. And here's the part that breaks expectations. This didn't happen after months of bad news, or slow grind lower, or some obvious collapse in demand. The market looked like it was in love with the metal, and then it acted like it couldn't wait to get rid of it. They say this kind of whiplash can't happen in a deep, liquid market. They say the plumbing is too robust, the hedgers too steady, the liquidity too thick. But the tape doesn't care about what people say. It only cares about orders, margins, and who is forced to sell. Because the truth is that when silver moves like this, the most important story isn't the candle on the chart. It's the chain reaction behind it. Institutions already understand that chain reaction because they design the arena where it plays out. Most traders only see the final print after the damage is done. And what I'm about to lay out isn't opinion, it's pattern. It's the same mechanical sequence that has shown up in silver's biggest dislocations across decades, and it's showing up again right now. Welcome to the Data Ledger, where we decode what matters before it becomes a headline. If you're here for narratives that sound good, you can find those anywhere. If you're here for the actual signals, margins, positioning, inventory stress, and the moments when markets contradict themselves, you're in the right place. If this is your first time here, consider subscribing the way you'd keep the number of a calm friend who tells you the truth when everyone else is shouting. And tell me in the comments where you're watching from, because the silver market looks very different depending on which side of the world you sit on. Now let's reconstruct what actually happened, because the sequence matters more than the conclusion. In the final week of January 2026, silver was already elevated, already volatile, already attracting the kind of attention that pulls in fast money. Business headlines were talking about silver trading around $188 after briefly exceeding $117. But the year starting with silver up roughly 50%, while gold was up far less. But that rally had a strange character. Even as price was ripping higher, some parts of the Western paper market were not piling in the way you'd expect during a clean momentum run. The story coming out of the flow was that the strongest marginal demand wasn't necessarily wall. Street buying futures and ETFs with both hands. It was retail and physical demand, especially from China, pushing premiums in places where people actually take delivery. Then the catalyst hit. President Donald Trump announced that Kevin Warsh would be nominated to lead the Federal Reserve, replacing Jerome Powell. The market interpreted that as a potential shift in policy posture, and the US dollar caught a bid. In a world where precious metals are priced in dollars, that matters immediately. And in a market where silver had been behaving like a leveraged expression of fear, liquidity, and speculation all at once, it matters violently. Gold and silver sold off hard. Financial newswires described gold falling toward the mid-4,000s per ounce and silver dropping into the 70s. 10 after the prior session's plunge. This was not a gentle repricing, it was a liquidation event. But the nomination headline alone doesn't create a 30+% collapse in silver in a single day. That kind of move usually requires a second ingredient, forced selling. And forced selling in futures markets tends to come from one place, margin. As the rally intensified, the exchange that runs the most important silver futures contract changed the rules of engagement. CME Group, which clears and lists COMEX silver futures, announced higher margin requirements. For traders in the standard risk bucket, margins were raised to 11% of notional value from 9%. 9%. The change took effect from the close of trading on the next day. Read that again, slowly. In the middle of extreme volatility, the exchange demanded more cash from everyone holding positions. Not more conviction, not better analysis. Cash. And if you didn't have it, you had to sell. One detail makes margin changes especially lethal in silver. The contract is small enough to invite speculators, but large enough that a modest move translates into huge dollar swings. A single COMEX silver futures contract represents 5,000 ounces. At $100 an ounce, that is $500,000 of notional exposure. When required margin is around 11%, the cash posted can be near $55,000 per contract, and the rest is leverage. A $10 move per ounce is $50,000 per contract. That means one ordinary day can wipe out the entire margin deposit and trigger forced liquidation. Now imagine dozens of contracts, financed across accounts, all hit by a margin hike at the same close. Selling becomes mechanical. This is the moment most people miss. The price move isn't just a crowd changing its mind, it's an exchange tightening collateral at the exact moment the market is most levered, the exact moment the trade is most crowded, the exact moment the weakest hands are stretched. That is how a trend turns into a trap. So you get the perfect storm. A catalyst that strengthens the dollar and shakes confidence, plus a margin hike that forces liquidations, plus a market that had been running hot enough to attract momentum traders who don't carry extra cash. The result is a violent flush. And yet, while the paper market was flushing, the physical market was telling a different story. That contradiction is where the real signal lives. Here's the hidden pattern. Silver is a market that periodically forgets what it is. Sometimes it trades like a precious metal, a monetary shadow, a cousin of gold. Sometimes it trades like an industrial input, tied to manufacturing cycles, electronics, and solar demand. And sometimes, usually at the worst possible moment, it trades like a leveraged financial instrument whose primary job is to expose who is overextended. When that third mode takes over, history rhymes with brutal clarity. In 1980, silver became the stage for one of the most famous commodity squeezes of the modern era. The Hunt brothers amassed enormous exposure and the market ran higher in a frenzy. Then the rules changed. Margins were raised, trading restrictions tightened, and the ability to finance positions evaporated. The price collapsed, and Silver Thursday became a permanent lesson. In commodities, when leverage meets rule changes, price can fall faster than any fundamental can justify. In 2011, silver surged again, reaching the high 40s per ounce, fueled by monetary fear after the financial crisis and a wave of speculative appetite. Then volatility spiked, margin requirements were increased multiple times in short succession, and the market rolled over. Silver didn't decline like a slow-moving asset. It dropped like a trade that was forced to unwind. And now look at 2026. The story is different on the surface. Different macro backdrop, different headlines, different crowd psychology. But the mechanism is familiar. A steep ascent attracts leverage. Volatility rises. The exchange responds by increasing margin. The market's funding costs jump. Weak hands sell. Strong hands wait. The tape prints a collapse that looks like a mystery unless you understand the plumbing. This is not a conspiracy. It's a design feature of leveraged markets. The exchange's job is to manage risk to the clearing system. When volatility increases, margins increase. When margins increase, those without cash reduce exposure. When exposure is reduced into thin liquidity, price gaps. The result is a crash that feels like it came from nowhere. Now let's talk about the players, because silver is not moved by anonymous forces. It's moved by institutions, rules, and a small set of venues that control access to liquidity and delivery. Start with CME Group. The moment they lift margins, the entire futures ecosystem must adjust. Clearing firms pass requirements to clients. Brokers demand additional collateral. Risk managers tighten limits. The paper silver market becomes a cash market overnight, and anyone who treated it like a cheap lottery ticket is forced into the exit. Then consider the macro institutions shaping the dollar and rates narrative. A Federal Reserve chair nomination isn't just political theater. It influences expectations for rates, balance sheet policy, and the path of the dollar. Reports at the time emphasized that Warsh was viewed as more conventional and potentially more hawkish on the central bank's balance sheet, and markets responded by pushing the dollar higher. Whether that interpretation holds over months is less important than the fact that it mattered immediately in the moment of maximum leverage. Next, look at banks and large dealers. They are the intermediaries in futures. They provide liquidity, hedge flows, and manage inventories. They also understand exactly where forced selling is likely to occur. When margins jump, they can anticipate which segments of the market will need to reduce risk. They don't need to predict the future. They only need to know the distribution of leverage. Now bring in the positioning data. The CFTC's Commitments of Traders reports show how non-commercial speculators are positioned. 2,000 the prior reading. That's a snapshot, not a verdict, but it matters because it shows that even as price was dramatic, speculative positioning was already shifting. The market was not a one-way consensus. It was a tug-of-war where the ropes snapped. And then there are the physical conduits, ETFs and vaults. The iShares Silver Trust is one of the largest visible holders of silver, and late December figures cited its holdings around 529 million ounces. That's a staggering quantity, and it matters because it represents a bridge between financial demand and physical metal. When ETF holdings rise, it can reflect new buying that must be sourced in the physical market. When they fall, it can reflect redemptions that release metal back into the system. Either way, it is part of the pressure picture. Outside ETFs, there's London. The LBMA publishes vault data that gives a rare window into what sits in commercial vaults, 4 billion. This is not the entire world's silver, and it is not necessarily available, but it is one of the few official numbers the market can point to. And when price dislocates, these stocks become part of the narrative. Now, here's where it gets interesting. Even as the paper price was melting down, the physical market signals were flashing stress. One of the most telling signs was geography. Reports described Shanghai trading at record premiums over London benchmarks. At one point, more than $14 per ounce above London, with local premiums described as over $14 and lease rates around 3%. Another description highlighted premiums in the neighborhood of $9 per ounce, pushing local prices to around $112 while the global benchmark was lower. That is not a normal premium. That is a message. Physical metal in that region is more valuable than the paper quote suggests. Think about what that means. If the paper price were a perfect representation of physical reality, the gap couldn't persist. Arbitrage would close it. Metal would flow from low-priced regions to high-priced regions, profits would be captured, and the market would converge. When it doesn't converge, you're looking at friction, shipping, financing, delivery constraints, regulatory limits, inventory scarcity, or some combination of them. The market is telling you that the same silver is not the same silver when you change the place, the form, and the immediacy of delivery. That is the dislocation, paper versus physical, west versus east, screen price versus the price people actually pay to take metal in hand. So why did the paper price collapse while physical premiums stayed elevated? Because these are different markets with different constraints. The futures market is a leveraged arena. It can be dominated for short periods by margin requirements, risk limits, and funding costs. It is optimized for hedging and speculation, not for moving bars. The physical market is constrained by inventory, logistics, fabrication, and immediate demand. It is optimized for delivery, not for leverage. When volatility spikes, the futures market can become an instrument for forced selling. When physical tightness exists, the physical market can remain firm or even get tighter. That's how you end up with a chart that looks like a collapse and a supply chain that looks like a squeeze. Now let's put numbers on the evidence, because the story only matters if it's measurable. First, the move itself. Silver traded near 108 ton on January 28, 2026, and then crashed into the 70s. Reports described a one-day plunge of roughly 28 to 31%, with intraday declines described as much as 36%. Those are once-in-a-generation numbers for a major metal. You don't see them often outside of crises. Second, the rule change. 9% effective from the close of the next day. That is the mechanical trigger that turns volatility into liquidation. Third, the cross-market gap. Shanghai premiums were described as roughly $9 to over $14 per ounce above London, with Shanghai prices quoted around $112 at points when global benchmarks were meaningfully lower. That is a massive percentage premium for a commodity that is supposed to be globally fungible. Fourth, the positioning shift. 2000, suggesting speculators were already reducing exposure into the turbulence. Fifth, the vault baseline. London vaults reported 27,118 tons of silver at end December 2025, which gives a scale reference for how much metal sits in the primary institutional storage hub. Put these together, and you don't get a tidy story, you get a pressure map. You have leverage unwinding in paper. You have tightness signals in physical. You have a rule-based margin shock that demands cash. You have a macro headline that strengthens the dollar, and you have a market that had been running hot enough to tempt anyone with a charting app. Now we have to explain the mechanism in plain language, because this is where most commentary fails. People describe what happened. They don't explain how it happened. Imagine a crowded theater where tickets were sold on credit. Everyone is inside because the show was incredible last week, and the reviews are glowing. That's a margin call. It doesn't matter if the show is still good. It doesn't matter if the seats are still valuable. People who can't pay have to leave. And if too many people rush for the exits at the same time, you get a stampede. In futures markets, the stampede shows up as a cascade of sell orders. Stops are triggered. Liquidity thins. Market makers widen spreads. Price gaps lower. Then risk systems see higher volatility and demand more collateral, which forces more selling. That feedback loop is the whiplash. The exchange doesn't need to want a crash. The crash can be an emergent outcome of risk management meeting leverage. At the same time, the physical market doesn't care about your margin call. A refinery in Asia that needs silver feedstock for manufacturing doesn't stop needing silver, because futures margins changed. A buyer who is paying a premium for bars doesn't stop because a chart printed a gap down. Physical demand can be sticky, and physical supply can be slow to respond. That's why the premium can persist even as futures fall. So what does this mean going forward? Historically, when silver experiences a leverage-driven flush while physical signals remain tight, one of three paths tends to follow. In the conservative scenario, the market stabilizes at a higher plateau than where the move began, because the flush removes the weakest leverage, but the underlying demand base remains. Volatility compresses, the dollar narrative cools, and silver trades in a range while inventories and flows slowly adjust. In the moderate scenario, the dislocation widens before it closes. Paper markets remain turbulent, physical premiums stay elevated, and the market oscillates between fear and scarcity. In that environment, the most important signals become the ones that reveal whether metal is being drawn out of visible inventories and whether delivery stress is increasing or easing. In the aggressive scenario, the market attempts to reconcile the contradiction in a single violent move. Either paper collapses far enough to crush physical premiums, or physical tightness forces paper back higher as shorts and hedgers scramble to secure deliverable supply. This is the path that produces the biggest headlines, but it's also the path that depends most on timing, liquidity, and the behavior of intermediaries. Notice the language, not predictions, conditionals. If the dollar continues to strengthen sharply, historically precious metals tend to struggle, especially the most volatile ones. If margin requirements stay elevated and volatility remains high, historically leveraged participation tends to shrink. If physical premiums remain historically wide while visible inventories tighten, historically the pressure tends to show up somewhere, either in higher lease rates, tighter spreads, or delivery dynamics. So what should be watched? Not opinions, indicators. Watch the exchange and clearing system. When margins rise sharply, it's a sign that volatility has reached a threshold the system is responding to. Watch whether those margins are reduced later, because reductions can signal volatility is calming and leverage can return. Watch the dollar. A small move can matter in a crowded trade. When the dollar catches a bid at the same time margins rise, that combination is historically toxic for metals momentum. Watch the gap between regions. Premiums in Shanghai relative to London are a real-time stress indicator for physical tightness. When that premium compresses, either supply has arrived or demand has eased. When it widens, the physical market is pulling away from the paper, quote. Watch speculative positioning. When non-commercial net longs contract into a sell-off, it can mean weak hands are being forced out. When they expand aggressively into a rally, it can mean leverage is building again. And watch visible vault numbers where they are credible and consistent. London vault totals provide scale. ETFs provide a bridge between financial and physical. And exchange-reported warehouse stocks provide a pulse on deliverable supply. You're not looking for one number. You're looking for direction and inflection. This is the divide in every market, but silver makes it painfully obvious. There are participants who trade the chart and call it analysis. And there are participants who trade the structure and call it risk management. The difference is not intelligence, it's focus. When leverage is building, the crowd feels smartest right before the flush. When margins change, the crowd feels victimized right after the flush. Institutions feel neither. They read the rule book and the balance sheet. The information gap becomes a wealth gap because the reaction function is predictable. The exchange raises margins when volatility rises. Leveraged participants are forced to reduce. Price overshoots. Liquidity vanishes. Then, when the market finally calms, the same participants who were forced out watch price stabilize without them. That's why what traders missed is rarely a secret indicator. It's usually the obvious mechanism hiding in plain sight. Silver's worst whiplash in years wasn't just a story about a metal. It was a story about how modern markets enforced discipline. A nomination headline shifted the dollar. A margin hike demanded cash. A crowded trade became a stampede. And underneath it all, the physical market kept whispering that scarcity doesn't disappear just because futures screens are red. This is the data ledger, where we decode what matters before it becomes a headline. If this connected dots you hadn't seen, margins, positioning, premiums, and the way paper can diverge from physical, you know what to do. Because the question isn't whether markets will keep creating moments like this. The question is whether you'll recognize the mechanism before the next whiplash makes it obvious.